everyone. Thanks for joining us, depending on where you are. Good morning, good afternoon. Yes, Sogol Clark is my name. I'm the Wealth Sales Director with Sun Life. Today, I'm going to talk about building sustainable income as we are in the current environment with interest rates going up. Annuities are back in fashion. Guaranteed income is back in fashion. It's sexy again. People want to talk about guaranteed income. We're getting a lot of inquiries about it. I feel like maybe our annuity team was sleeping for the last few years and now they're back up again and we're hiring more people just because the demand has been so high. I was looking last week in the country nationally, we've done about $350 million year to date in annuity sales. So I'm going to walk you through a few different options that we have on the annuity side and on the segregated fund side on building sustainable income. Before I start, I just want to give you a little overview because I think a lot of people know Sun Life as an insurance company, but I think it's important to know that we manage about $1.3 trillion assets under management. So that includes MFS out of Boston, which is about $700 billion AUM, and Sun Life Capital Management, which is our fixed income desk, who's about $350 billion. And then we have Everbright in China, Birla in India, we have Sun Life in Hong Kong and Sun Life in Philippines as well. Sun Life Global Investments is who I'm hired with, and we manage about $55 billion AUM, and we launched Sun Life Global Investments in 2010. So we're responsible for mutual funds, segregated funds, payout annuities, and insured GIC. And one of the areas where I think Sun Life really stands out is our relationship with third-party asset managers. So if you're using us on the mutual fund side or on the segregated fund side, you have access to a lot of the managers that you would not have access to directly. Birla out of India, MFS out of Boston, KBI out of Ireland. We have Wellington, there's Schroders for emerging market. We have tons of different options that you have access to via Sun Life. Just to start, before I start the presentation, just a little overview of what we do at Sun Life. Sun Life Consulting is a big part of our offering. They bring out programs to kind of help your business move forward. I'm a huge fan of our client segmentation model. If that's something that you're looking at, we do have tons of great options that the consultants can work with you on segmenting your book of business, moving into service levels, client engagement process. So there's tons of options out there. We have tons of information on generating a brand story for you. What is your value proposition? Aging and incapacity has been a very popular one. Behavior-focused advice was one that was really popular last year just because of the way the markets were, and a lot of the advisors wanted more talking points and talking to clients in a down market. So there's tons of opportunities within our consulting team that you have access to via your wealth sales director. And then I think one of our most important parts of our business being financial advisors, either on the insurance side, segregated fund side, is dealing with accountants. So we have an accountant per region that works with our wholesaling team. And I think it's really important to have an accountant that understands segregated funds, understands corporate class structure, understands insurance contracts. A lot of times accountants don't know these things, and there's such a disconnect where if an advisor talks to an accountant, it's a sales pitch. If a wholesaler talks to an accountant, it's a sales pitch. But when accountant talks to accountant, magic happens. So it's really nice to have an accountant on our side of the business. So definitely utilize that. You have one in every territory. We have one in Eastern, one in Central, and one out West. I'm very lucky because our accountant lives in the Okanagan, and he's the president of Chamber of Commerce in Kelowna. His name is Dan Price. So if there's ever any complicated case scenario that you're working on, you're following my territory, he's available for consulting as well. And then last but not least, our website, everything's moved outside of the portal. So you actually don't need to log in for any information, only client access. So all the education hub, CE credits, videos, tools, everything you have access to without actually using a user ID and password. So there's tons of great information. I always say the challenge that we have is that there's too much information at Sun Life. So if you're looking for anything specific on a certain topic, we do such a great job of creating great marketing material, but there's just so many things that are available. So definitely reach out to your wealth sales director and they can direct you to the right product and the right information you're looking for from a marketing standpoint. So let's get started with some information like where we're at. So 62% of working Canadians believe they're at a serious risk of outliving their retirement savings. 31% of working Canadians, only 31% have a financial plan. We did a survey and 80% of individuals wanted some form of a guaranteed income in retirement. A lot of that is moved from the defined benefit plan, where a lot of individuals knew exactly what dollar amount they were going to have in retirement, to a defined contribution plan, what we call it the do-it-yourself plan. A lot of people don't even have a pension plan anymore. So what are they relying on for guaranteed income? The options that are really available for guaranteed income are defined benefit pension plan, old age security, CPP. I was doing a presentation for a group recently, and I asked the question of what is a form of guaranteed income, and someone said GICs. that GICs are definitely not a form of guaranteed income. So our options are very, very limited in terms of like what offers the most for guaranteed income for longevity risk and no market risk. So that's what we're looking at for something that offers you a guaranteed income for life. When we look at these options that you have from a guaranteed income standpoint, if you're talking to a client and you're doing planning and you're covering their non-negotiables, you're looking at CPP, you're looking at OAS, you're looking at defined benefit if they have one. And if they don't have one, maybe they have a defined contribution plan, or they might not have a pension at all. So when it comes to their basic living needs, how are you going to close that income gap? What other options do you have that's available? And the reality is that people used to retire at age 55, 60, and they would pass away in their 70s. But now people are living longer. So you have to generate another 30 years of extra income for your clients based on the fact that they're going to be living longer and their expenses are going to go higher and higher. So today we're just going to talk about longevity risk. What does that look like for us in Canada? Building a sustainable income portfolio, and then the benefits to your clients as well. And I'll walk through some of the flexible options that we have available on the income side as well. Longevity risk, this is no news for us. Average individual age 65 for a female lives up to age 89. For a male is age 87. This gap is narrowing, but I think it's a reality in Canada where we see people are living longer and longer. I just read an article that in US, actually the longevity is coming down. So people are actually living less than what they used to live. But in Canada, it's the opposite, where our age gap is narrowing and individuals are living longer and longer. This was very interesting. The census is done every 5 years, and you can see that by 2065, the fastest growing population in Canada are going to be centenarians. And these are people over age 100. So you're looking at about 90,200 individuals that are going to be over age 100 by 2065. Another interesting stat is people living in Canadian senior residences. This number was at 450,000, and this will jump up to 650,000 by 2030. So the cost for housing for these individuals is sitting about $140 billion. I covered the Okanagan as part of my territory, and we had an event yesterday, and I was talking to an advisor, and he said that his parents are waiting for a home, and they've been on a wait list for about 20 months. So, and the cost of the home that they're going to be in is $7,000 a month. So you can just imagine what that looks like from a cost standpoint and from a capacity standpoint with so many individuals on a wait list to get housing. And then last but not least, health issues rise. Health costs rises quite a bit as you get older. So 65 to 69, you're looking at average health cost of $6,424. That number jumps to about $8,379 by 74. And then that number goes up to about $11,488. And when you see it skyrocket is from age 70 to age over 80, where you're looking at number go up to about $21,000 per individual for people that are in age 80 and over. So definitely our reality is we're aging, the cost of living is going up. And if we're going to be living longer, how are we going to basically cover those costs going forward? Life annuities, I do send out an email blast to my territory once a week on our rates. And I get about 50 to 55 individuals emailing back asking for quotes. And some of the questions that I get on annuities, I think they've been out of style for so long that a refresher is sometimes needed. So a life annuity offers you a guaranteed income for life as long as you live. The older you are, the higher the payout because of mortality credits or insurance credits. So if you're a male, you get paid more than a female. We get paid lower because we live longer. But the older you are, the higher the payout. So they're a very attractive option for individuals that are older. Prescribed taxation for non-registered assets. So it makes it very tax efficient for a lot of individuals that are looking for tax efficient income on annuities because it gives you level taxation, which I'll talk about. So this was always the myth of interest rate moving with life annuity rates going up. It's interesting because when I look at rates, like if rates go up 2.5%, annuity rates don't jump up 2.5%. If I run a life annuity quote today versus 2 years ago, my income's gone up about $1,700. The income hasn't gone up that much because a big component of life annuities is mortality credits or insurance credits and interest rates. Where we've seen the most jump is on term certain annuities. Term certain annuities are based only on a term and not based on age and gender. So if I run it for a 20-year-old or 90-year-old, I get the exact same payment. If I run it for a female or male, I get the exact same payment. Life annuity is where that component of mortality credits plays a bigger part than interest rates. Whereas with a term certain annuity, it's just based on interest rates. So that's why we've seen a lot of back-to-backs come into play, where people are buying term short annuities to pay for an insurance policy. We hadn't seen those in the last probably 15 years, where you would never see a term short annuity be attractive enough to pay for an insurance policy. But now they're all coming back, and you're looking at about 4.5–5% on term short annuities, where it's actually very attractive to pay for an insurance policy. But really, that interest rate movement, it doesn't have a direct effect on life annuity payouts because of the mortality credit component of life annuities. Another myth about life annuities that what if I don't get my principal back? So there's always a concern about the guarantee period. So what we mean by guarantee period on a life annuity is that if you buy an annuity with a 10-year guarantee period, we're guaranteeing you to pay you that income for life. But if you pass away within that 10 years, the remainder of what's left will be paid to the beneficiaries. And that's what a guarantee period means. So you can go up to age 90 for a guarantee period, which means that if I have a 70-year-old client buying a life annuity, they can go up to 20 years of a guarantee period. So if they pass away within that 20 years, the remainder of what's left would go to the beneficiaries. And that's always the concern with the flexibility of annuities, where they're not flexible, I don't have access to capital, and what if I don't get my principal back? So we ran a hypothetical scenario, just give you some ideas around the age of what guarantee level you need to get your money back. At age 65, it's about 13.8 years. At age 70, it's about 11.7 years. And at age 75 is about 9.9 years. So it's actually not that bad from a standpoint of a client, but it's when I see life annuity cases done, majority of the situations is a female who has longevity risk. Her main concern is income. But sometimes if a client has more wealth and they want to allocate a portion to their kids, you tend to buy a longer guarantee period. But nowadays with companies, like if you go from 10, 15 to 20-year guarantee periods, it's usually the cost is not that different. Like you might lose income by like $50 a month. So it's not a huge drop in income. So it's definitely good to play around with numbers, to take a look. And especially if you're running quotes on Canex through your MGA or through your office, always make sure you look at the taxable portion and the income amount, because with every company, the taxable amount is different and the income amount. So compare both, because a lot of times you might go with the highest income with one company, but then their taxable portion is a lot higher than another company with a lower income amount. So definitely consider all that information. And that walks me to my next slide, taxation of annuities. We get questioned on these, especially on non-registered accounts, so much because they're very tax efficient, and you're only getting taxed on the interest, and that's the portion you're paying taxes on. There's two different types of taxation on annuities. There's prescribed and accrual or non-prescribed taxation. The difference is non-prescribed taxation, which is accrual taxation, is level taxation, which means like you get taxed a lot more at the beginning, and then that number goes down. With prescribed taxation is level taxation, which you get the same amount taxed every year on your annuity. And now it's interesting because for people, some of the individuals over age 80 with certain companies, because based on CRA's mortality tables, they assume that the client's already too old, you pay zero taxable income on a life annuity. So it's good to play around with it for individuals that are older, because sometimes you can actually bring their tax levels down by buying an annuity from a tax efficiency standpoint, especially when you compare it to like a GIC account where it's 100% tax as interest income. So there's some tax efficiency options with a life annuity. The only area to consider when you're doing if an owner of an annuity is a corporation, it will be non-prescribed. Also, if there's an owner and an annuitant different. So for example, we just did a recent case where mom is 75, she wants guaranteed income for life, but she's taking government benefits, and we don't want her to pay taxes on that annuity. So we had her son own the annuity and mom as the annuitant. In this case, since we have different parties of a contract, it has to be non-prescribed taxation as well. And if we have another situation where, let's say somebody's funding the policy for an individual to buy an annuity for themselves, let's say you're gifting someone to buy an annuity, a family member or something, since there's a third party gifting that money for the life annuity to be purchased, that is non-prescribed as well. So keep that in mind. If there's another change in the parties of a contract with a life annuity or a term short annuity, it will have to be non-prescribed taxation. Same applies to term short annuities as well. But majority of the time, if it's just a simple same individual owning it and not a corporation owning it, you would have prescribed taxation on an annuity. So I wanted to do a sample illustration of putting 25% allocation to a life annuity as a sample, just to show you what that looks like to incorporate a portion of guaranteed income for a client in their portfolio. So here we have an account, $500,000. individual wants to do a 4% withdrawal rate. The average rate of return on the portfolio that we're looking at about 5.5% return. So here, 4% for $500,000, that's $20,000 of income that we want to take out. If I actually take out 125,000, 25% of that, 25%, 125,000, and put into a life annuity for a 65-year-old male, my guaranteed income for life for that person is $8,035. If I take the remainder $375,000 and take the 4% from that, it's $15,000. So now my income's sitting at about $23,035. If you recall from my last slide, the original income that I was going to get was $20,000. So now I've generated the clients another extra $3,035 by allocating 25% of that money into a life annuity. And we see this come up all the time where individuals look at people's like cost of living and they're like, okay, I have a nervous female client and I know she's worried about longevity risk. She's worried about market risk. Let me allocate a portion of the money based on her cost of living into a life annuity product. And then the rest of the money I can play with in the equity market. And I don't have to worry about taking more equity exposure because she's got her guaranteed income and she's never going to run out of money. So it's a fantastic option. And always consider that with any life annuity product, you can actually work out, like let's say you just want $1,000 a month. Our illustrator will show you how much you need to put into an annuity for the 75-year-old lady to get $1,000 a month for her as long as she lives. So it's really nice. You can actually work it backwards. I just ran a quote for an individual who wanted $45,000 a year to live on, and they didn't want to take any market risk because they're getting super anxious with the way the markets have been behaving. They're super nervous. They're in their 70s. They want $45,000 a year of guaranteed income. So we allocated that portion into a life annuity, and the advisor can play with the rest into a mutual fund portfolio. So you can definitely utilize combination of products to accomplish results for your clients. We talked a little bit about life annuities, what they look like. Joint life annuities are really good as well. So if you have a husband and wife situation, you can actually buy an annuity on both lives. And I like life annuities because if there's a huge age gap between husband and wife, like you have an 80-year-old and a 60-year-old, we take the blended rate. So you're not really losing a lot of income by buying it for a 60-year-old and an 80-year-old. And we offer you a guaranteed income for life for both of them as long as they live. We just did a recent $5 million case where the individual sold a business, husband and wife, and they just wanted to buy a life annuity because they don't want any market risk, any longevity risk, and they get that guaranteed income for life. Term certain annuities we talked about, they're back in fashion. If you haven't looked at term certain annuities and you're doing a lot of insurance contracts, definitely take a look at them, because I just did one for a 10-year premium, $100,000 per year for a client. An average saving, I think it was about $220,000 that the client would save if they bought a term certain annuity to pay for the insurance policy. So the rates are very, very attractive. I just ran a recent comparison to RBC 5% GIC Direct. They were promoting that quite a bit. For a 65-year-old female, 20 years of income, zero left at maturity. RBC was offering $3,000 a month. When I ran the term certain annuity for us, it was $3,600 a month, and it still bypasses probate. They can name beneficiary, and it's a lot more tax efficient. So if you're looking at options for clients for income or to pay for an insurance policy, term certain annuities are back in fashion. The rates look very attractive. Enriched annuities, which is a fancy name for impaired annuities. These are for individuals that have diabetes, high blood pressure, MS, cancer survivor. It totally depends on their medical history, what that looks like. So you can go up to age 85 for enriched annuities, but you want to make sure that it makes sense to actually get the letter from a doctor, because I find 12, 13 years ago, they used to be very attractive. You would get like a +8, +9 ratings, but now the most that I see in ratings in the industry is about +4, +5. So actuaries have gone very, very conservative with these ratings. So it's not as attractive as they used to be. But again, it's an option that's available if someone's had heart surgery, implants, or something where it's like there's been some changes, or they've been diagnosed with cancer or short life expectancy. It might be something to look at, but I don't see a lot of great ratings coming out from an actuarial standpoint. Copycat annuities, this was interesting because I think a lot of advisors are not familiar with it. So this was a provision in the Tax Act in 1997. Where you can actually take a defined benefit pension plan that's private. So not a public defined benefit pension plan. So not teachers, not firefighters. Private ones tend to be TELUS, credit unions, mining companies, some tech companies, where you can actually move a defined benefit pension plan over to an insurance company under a life annuity without paying taxes on it. So you can actually transfer the commuted value over, the RPP over, and you can actually buy life annuity. So for example, we just did a recent case for one of our clients. What we need is a pension package to say, exit package to say, Mr. Smith, you're ready for retirement. These are your options. Please select option 1, option 2, option 3. You send us that case. And in this situation, the advisor, the pension was paying about $2,200 a month, and it was $450,000. So for us to copy the exact same rules and the exact same income amount, Sun Life only needed $380,000 to offer the client the same income amount, and there was $70,000 extra that the client can take out to top up their RSP. So there's definitely an option to look at, because you get the business under your code, you're getting commission on it, you can service the client, and you can actually get paid for the services that you offer. And from an insurance standpoint, it's covered by $2,000 per payment. So a lot of times, if there's concerns about the pension plan not being able to maintain the payments, a lot of clients prefer to go with an insurance company. And sometimes we're not as cheap, we're more expensive. So it doesn't make sense to make the move, and sometimes we're equal to what the pension company offers. So it's worth to take a look. You send us the quote, and within 48 hours, we will give you an answer. Yeah, so people always ask us how to submit business on the annuity side. So you email us a quote, we run the quote for you, and once you review the quote with the client says yes, you send us an email, we confirm that guaranteed rate for you for 45 days, and we give you that 45 days to go fill out an application and send us the money. So it's just a very simple process. The only thing is, like with our applications, it's still paper-based applications with our team. So with our seg fund lineup, we have our 75, 75, 75, 100, and income series. Income series are guaranteed income for life product. It's only us and IA that offers this product in the industry. So it's a cashable life annuity product, basically. It's a 75-75 segregated fund. It offers you a guaranteed income for life with access to capital, which an annuity doesn't give you access to capital. And it pays you a trailer as an advisor, because the life annuity only pays you an upfront commission. It's 3% on the first 100,000, 2% on the next 100,000, 1% on the remainder. With income series, you can do chargeback at 3% for a 2-year schedule, or you can do front end, and you can actually get a trailer on it, which is really nice. And that's why a lot of clients like it more, because it's a more flexible option. You can run it on single life or joint life, and the cost total is 2.80 all in. With IA, it's sitting at about 3.33 all in, and they're available on single life only. So we're available on single life and joint life. But on non-registered, it's always based on the life of the younger spouse. So you want to always remember that. And it's invested in a 100% bond fund. You only have one option. This is not meant for growth, but the bond fund was down minus 13%. And if in the next few years you think rates are going to come down at some point, longer duration, high quality bonds are going to have very nice upside, even if the bonds market falls if their interest rates fall 1%. So it's an attractive option to look at, but this product is not meant for growth. It's meant for a payout rate guaranteed for life for your client. So if I have a sample where the individual is age 71, they're getting 5.74% guaranteed for life if they take income out this year. If they go into product and they take income out at age 72, which is January 2024, they get 6.07 guaranteed for life. And that's a guaranteed payout for life. This works really well for RIF clients with the big age gap. So if the husband's age 80 and the wife's age 60, we run the income on the husband's age, and then we name the wife as successor annuitant. So once he passes, she still receives the same income amount. So keep that in mind for individuals that have a bit of an age gap between them from a husband and wife situation. But let's say we talked about annuities before. They give you no access to capital. This product is more flexible on the access side. So how much more income do you get from a life annuity? This pays you 5.74 guaranteed for life. A life annuity would pay you 7.7% guaranteed for life. So an annuity always pays you more because of no access to capital, no flexibility, and you have to basically consider the guarantee period to leave money for the next generation. Whereas the income series gives you access to capital, pays you a trailer, and the client can change their mind, pull their money out. So definitely it's another great option to look at that's available through us. And last but not least, we have the annuity settlement option. I'm very passionate about this concept because I think it's the most underutilized concept in our business, where you can actually have an annuity on death for the beneficiary to receive payments instead of a lump sum amount. So we call it control beyond the grave, and I think it's an attractive concept. They can always add on to a contract. Privacy of the beneficiary designation on an insurance contract or a segregated fund contract, where you can actually say, for my spendthrift child, I want them to receive payments instead of a lump sum amount. I want them to receive an annuity payment for life. Let's say they set it up today, they change their mind, they can take off the form. Few years, they come back and tell you, you know what, now my son is a drug addict, I want to add this on, you can add it on. So the annuity settlement option, I think it's a beautiful concept that you can utilize, where you can actually give control to the individual of how that money is going to be spent. And the difference between putting it on the beneficiary designation versus putting it as part of the will is that on the will, it can be contested. It will become public record, whereas on a beneficiary designation on a segregated fund is private and it cannot be contested. So the alcoholic beneficiary can kick and scream all they want, but they're not going to have access to funds. And that's why the annuity settlement option is a very powerful concept that you can utilize. There's a sample case scenario that I wanted to go through. I'm just looking at time. I still have 2 minutes. Perfect. So Heather, she inherited $250,000 and she's in a second marriage and she wants to leave funds differently to her children. So the money is invested in a segregated fund contract, and we're using the beneficiary designation to set up the annuity settlement option. So when she fills out the annuity settlement option form, she can actually say, I want $25,000 lump sum to be paid to Ben. I want $175,000 to be paid to Ben over a 10-year term store annuity. She could even defer that term store up to 10 years. So if she wanted to bypass a generation, she could have done that. We can do Sam $25,000 5-year term store annuity, and for Lori $25,000 lump sum. So this is all done with one additional form on the seg fund application, on the beneficiary designation, and this cannot be contested. So Ben can't go after Sam, Sam can't go after Lori. It's all set in stone and the money gets paid. And you as an advisor get paid commission on that $250,000 annuity once it's issued. Today, we talked about longevity risk and the guaranteed income. I think there's a huge opportunity for looking at guaranteed income option for your clients to complement what you're doing. Based on the number of inquiries that I'm getting and the requests that I'm getting, I think there's a big opportunity where you can actually utilize the high interest rate environment for your clients and give them some comfort in an environment where they not want to be worried about running out of money.
Thank you, Sogol. That was a great presentation, a great refresher, a lot of really good information. I think there was one question. Maybe we can do that very quickly. So
of course.
Gord Johnson is asking, how is this different to a GMWB between Sun Life Income Annuity, the 75-75?
Perfect, thank you. Yeah, so a GLWB product would offer you a notional bonus amount. So a GLWB would be great for someone that's like 10 to 15 years away from retirement. And to be honest, I think the only standing GLWB in the market like still functions like a GLWB is Empire Class 3.0. Every other product is a watered down version of it. But this product income series is for instant income. So it's for someone who wants income this year or next year. It's not for someone to park their money there for like 5-6 years because there's no 4%, 5% notional bonuses anymore. So this is for someone that's looking for instant income right now. And that's why the cost is 2.80 versus 3.4, 3.5%.